Hey there, friend! Welcome back to the Closing Chapters podcast, where every mission has a story. So, I have one big purpose that we want to talk about today, and then I'm going to follow up with kind of what you were saying about the closing costs. I would love to know, like how should we be using any concessions we get from a seller appropriately? But my big question mark, and I've had quite a few people reach out to me and ask me about this lately, is if they bought in 22 to now 24-ish, and their VA loan, should they even consider refinancing? Most of these people are at 6.25 to 6.75 in their interest rate. Hey there, everybody. Today is going to be an awesome day. We have a phenomenal guest that has actually talked with me before, and we have constant communication all the time. Matt Wilson is my personal lender, and he is my preferred lender for a lot of my clients. And the thing that I appreciate the most about Matt is his transparency. And you will see that throughout our conversation. There is nothing that gets hidden behind doors when it comes to Matt. He lays it all out on the table. He's extremely transparent and he shares with both the client and the agent. So, agents, listen up. If you do not have a lender that is truly showing all the information to you so that you can continue to have educated conversations with your client, you might need to make a switch. And Matt's a great option, especially if you're in the Tennessee market. So I want to give you a second just to say who you are, what you love to do, and a little bit about your background, Matt. So tell us about yourself.
Absolutely. I'm Matt Wilson, the loan father. And I've been in mortgage for about 9 years now. Did consumer lending before that. Basically, every real job that I've had has been some sort of finance. Also served in the Air National Guard for 6 years in Tennessee. Definitely got a little bit of a veteran background as well. As far as what I do for fun, basically wait for college football season to roll around, and that's when I have fun. And then the rest of the year, I just work.
There you go.
um, yep, got three boys that are of varying ages that basically act like raccoons and badgers in the house. So, you know, usually fixing something every evening that they've broken through the day.
We've had quite the stories to share between both of that. We have kids that are similar ages, and we love comparing notes on who's doing what, like at each phase of life. It's been fun to keep up with that. So tell me, on the lending front, what's the current status, in particular for like VA loans? If I have a VA buyer right now, like what should I be telling them to expect? What are the kind of like the rates? Is there anything special going on or things that they should be aware of if they're making a decision to buy right now?
Yeah, so I think it's a fantastic time to take a look at buying. Rate wise, things are probably 3/4% lower than they were this time last year, maybe a full percent, depending on how the market's moving from day to day. One of the big things that people don't realize is that you've got the ability, like rates move constantly. Think of it kind of like gas prices. As you're driving to work, you're like, oh, I'm going to that gas station. Well, after work, a different gas station may be cheaper. But I work for a company where we can compare gas stations, so to speak, so that we can still make sure that depending on how the market's moving around, somebody may just price it out slightly better at that given time. But all that to say, it's also kind of a lull right now, I think, leading into the spring market. I think this year is going to be a whole lot more seasonal like it used to be pre-2020.
Mhm.
I think, I don't know what you've saying, but it seems like 2020 and 2021 was like 2 years of a spring market. And then 2022 and three was kind of the fallish thing. And then 24 and five was the winter. And now maybe we're
Yeah.
back to a normal market again. So that's what I'm seeing is that right now there's kind of a loose window, at least in Middle Tennessee, where things aren't crazy yet. Nobody's asking you to name your dog after them to buy the house or anything ridiculous like that anymore. And sellers may actually pay some closing costs too, in a lot of cases. Um, I've seen this window kind of existing for, I don't know, probably about 6 months now, and believed in it so much that I sold my previous house and moved myself, because I'd rather get a slightly better deal and give a slightly better deal when I'm moving up than get a worse deal
Mhm.
moving up and a better deal selling.
Right.
So that's what I've been seeing over the last couple of months here. It's also kind of interesting that lead flow and people talking about mortgages and buying a house has been in direct proportion to how cold it's been outside. So like when it was icy and nasty across the southeast, like the phone was not ringing.
Hmm.
Turned 60 degrees, and all of a sudden everybody's like, "Hey, I think I want to go look at houses this weekend."
Yep. Yeah. Yeah. I totally agree with you. As soon as we got past the like 2 weeks of like crazy weather, everything started having an uptick of showings. And I have listings across 3 states, and all 3 states, they all just all of a sudden started showing. It was really strange. So yeah, I'm with you on that. It was like the everybody got stuck inside and remembered that they wanted to move for a reason. I think it was a great reminder, like, get me out of here and it is time to find a new space. I love it. So I have one big purpose that we want to talk about today, and then I'm going to follow up with kind of what you were saying about the closing costs. I would love to know, like, how should we be using any concessions we get from a seller appropriately? But my big question mark, and I've had quite a few people reach out to me and ask me about this lately, is if they bought in 22 to now 24-ish, and their VA loan, should they even consider refinancing? Most of these people are at 6.25 to 6.75 in their interest rate. So should they be considering refinancing, or should they just hang tight? Should we do the natural progression of like pay a little bit more towards your mortgage and bring the whole thing down? What is your take on that? Like, where is that barrier that we should consider refinancing?
Sure. So VA specifically, the VA would say you need to be able to break even within 36 months. I like
Okay.
to be a little bit more aggressive than that. And if you're wondering what a break even is, it's basically how much does the refinance cost? Because there is a cost. It may not be out of pocket for you, but it is going to add some closing costs to the back end of your loan. So how much does it cost? How much do you save? We just divide them across each other and see, where does it come out? If it's
Hmm.
12 months, 24 months. Because what you don't want to do is go just rate chase. I see people make that mistake frequently, and next thing you know, they've negated 3 years of paying principal on their house because they've got a fancy interest rate. Yes, the payment's lower, but was it the right strategy for their situation? So,
Hmm.
I don't ever tell people you need to have a specific, like you have to save 1% or 2% or anything like that. Um, I look at it completely from the break even and completely from what do you think is going to happen with interest rates? Because here's the dirty secret about all of it. Nobody knows what's actually going to happen.
Right.
You know,
Right.
we can give you educated guesses. Um, NAR, the Mortgage Bankers Association, Fannie, Freddie, Zillow, they've all got estimates they throw out there every year where they predict things to
Hmm.
go, and they're always wrong. Redfin, I think, was the closest to right the last couple of years, but statistically, that probably means they won't be this year. Um, so you can't predict the future. So one mistake that I made in 2024, that's when we first saw rates dip meaningfully for a second there, was I got greedy on behalf of some of my clients and was like, nah, we could save more. We're talking about some of these people may have been over seven because of when they bought their house.
Hmm.
Um, and then the market flipped so about as fast as it came in. It was like 2 weeks of rates that were substantially better, and then it was back to where things were, a month before it.
Yeah.
So you got to really be prepared and talk with the mortgage guy, me, whoever, and make sure that you've got a plan together so that when rates do hit that spot, you're ready to rock and roll. And it's not like, oh, now I got to turn my application in. Now I got to get going. And, now I
Hmm.
need to turn in documents. The thing with a VA refinance, if you're doing it purely for interest rate, is like, it's the easiest refinance there is. We don't do an appraisal. We don't verify income. Like, it's a much simpler, streamlined process. Um, so that's nothing to be scared of or worried about or anything like that. And if you do require the funding fee, it's cheaper on those. It's only a 0.5%. Of course, if you've
Okay.
got service connected disability and you're out of the military at that point or whatever, there is no funding fee. So it's just the closing costs. I've had families though where we only saved them a 0.5%, but the total refinance cost was about $1,000.
Yeah.
So it wasn't crazy, not a
Yeah.
crazy savings, but their break even point was like tomorrow.
Right.
So it just made sense because they felt like interest rates were going to go down, but it guaranteed they were going to get a lower rate, at least if they don't.
Right.
Um, so with that being the case, it's all situational. It's something that you've got to run your own personal numbers for. Another factor is if you don't think you're going to be in that house in 2 or 3 years, probably don't worry about refinancing. Um,
Yeah.
Like it's probably not going to be worth it unless it is something like where I saved the lady, a couple $100 a month and it only cost $1,000.
Right.
Um, Aside from that, you see people too. Several of my clients lately have chosen instead of refinancing into a 30-year, they're narrowing that term down to a 15, and the rate difference is enough that it's not much more in monthly payments, and they were already comfortable with the
Interesting.
payments. So their payment goes up $100, $200, but they pay off their mortgage in,
Yeah.
15 years less.
15. That's really cool. That's a really cool strategy, especially if somebody was like trying to build out their portfolio, and really
Hmm.
had a time. Like when you say that, I automatically think about, we try to have a property for each child and trying to pay it off before they're 18 so that we have options. Like that's really cool if you could swing that and it's not much different. Um, that is all really good information. So, can you explain to people why they are getting all of these love letters in the mail and phone calls from the lenders that say now's the time you should refinance, and whether they should actually like look into that or not? Like, is there any golden rule, or is it like a should you call anybody or should you go back to your direct lender that did your loan? Like, if you were going to consider refinancing or entertaining these conversations, who should you reach out to? Like, what is the go-to move there?
Yeah, I would say first off, don't reach out to the internet.
Okay.
Because what you find on the internet is a lot of bait and switch, really. They got to dangle something that sounds really nice to make you
Mm-hmm.
call them, and then you get into the process, and because you don't meet certain criteria, you're not going to get the rate that they told you. If you liked the person that did your mortgage the first go around, go back to that person
Right.
again. There's a reason you trusted them.
Mm-hmm.
If you don't like them, that's where call me. But you know, on the real, you get recommendations to somebody local to you,
Yeah.
and talk to them about what's available at any given time. To help with some of the closing cost or rate buy down, like I'm doing up to a 1% lender credit for people that refinance that's done a mortgage with me in the past.
Cool.
So for some loans that helps mitigate the closing costs to next to nothing.
Yeah.
Um, or you could use it to buy down your interest rate and get more savings if it mathematically just turns out to make more sense that way. Um,
Mm-hmm.
so that would be my thing. The reason you're getting all of that stuff in the mail is I've seen several reasons. So first off, it's public record that you bought a house. Um, it's not too hard to figure out roughly where your interest rate is based on the time frame that you bought your house. So snail mail still works in some cases. They're just bombarding you with stuff based on that. Even if you've opted yourself out from being pre-screened for pre-approvals and stuff like that through the credit
Right.
bureaus, you've got still ability to kind of know where people are at and send them letters. And these lenders are hungry. Like for the last several years, it's been ugly in the industry. We went from about 350,000 licensed originators down to about 70,000 now. Um,
Wow.
so it's a fraction of what used to be here. So they're
Yeah.
just thirsty lenders. That's all it is.
Gotcha. So you said something that was really important too when you were talking about like online, don't go looking for information online. What you said totally applies to what we're getting in the mail. There's also often that it'll say, you have $30,000 of untapped equity in your property, or I can offer you a 5.25 interest rate. That is not a fact. That is not a fact. That is the carrot being dangled in front of you to try to make you call. And then maybe, but it's probably never going to be exactly what they are saying. And the same thing for the equity piece. This is kind of sidebar for half a second, but like the equity piece is after you, like if you wanted to do a refinance and pull out equity, most people don't understand that you have to have so much that stays with the property. So, like for a conventional loan, you have to have 20% equity and then you get what's left. So, if you only have 30% equity in your house, then really you can pull out 10%, not 30. So, like, there's so, like you said, they're switching baits, right? They're giving you all this information and making it look like you can do something that you absolutely cannot. And they're just taking a wag. So, I agree that like you should call whoever you've used in the past. And if you don't remember the lender and you remember your realtor or vice versa, right? Call who you know and let them get you back to the right person. And that's one of the things that, like, whenever I call you, you were very clear about no, Brittany, that's horrible, or well, let's look at the numbers. I think there's a possibility there. And you also said when you were talking about like the gas, this is one of the things that I absolutely love that you do when you have a new buyer is you do a video showing exactly what you like to do, like, you know, what it looks like, what the options are, because I have a lot of people that are fancy, think they're fancy, and like want options. They think, oh, well, maybe I could do this and I'm going to get a better deal. And you do a phenomenal job showing across the spectrum what the different options are to compare them. But you also are the guy behind the screen watching the gas prices go up and down, which is something that I can't do. I don't know. I don't want to know how to do. So I think that's one of the hidden like secrets about lenders is if you have a lender that actually knows how to watch all of the different numbers going on with like the feds and the rates and how it all correlates, then like you have that assurity to have someone that's going to lock it in for you. And you've done that several times. You were very big with VA buyers on saying, hey, you know, like we're not going to lock in right now. I'm going to watch it. But when I say it's time, it's time. And I think that's really great. Like I think sometimes people don't realize that that's an option. You know, they think whatever I'm quoted
Hmm.
today is what it is. And that's not necessarily the case. So, yeah, that kind of leads me into like if we were looking to buy right now, what's our play? So a couple years ago, 2-1 rate buy downs, the 3-2-1 rate buy downs, they were like what we were told to do. That was the sweet spot was to, you know, if
Hmm.
your interest rate was 7.25, well, it was going to be 5.25 for a year and then 6.25 for a year and then finally go up to 7.25. And all the hubbub was in 2 years, the rates are going to be low enough that you just go ahead and refinance and then you're going to be fine. Um, I know we didn't end up getting as much of a drastic dip as we anticipated, but
Hmm.
for right now, is that still a good play? Like if rates are at 6.5 or 6.25 on average, could we do a 2-1 and get that rate down to 4.5%? And that makes sense? Or are we better just to naturally buy down the rate right now? What's your take?
Um, I usually don't like to buy down rates a ton to begin with. To kind of go into what that means, basically a rate buy down means that you pay a little bit more upfront to pay less over time. So your closing costs will go up and your rate goes down. Um, Sometimes it makes a lot of sense, sometimes it doesn't. It's literally case by case and day by day as to what I would recommend to anybody on that. So I won't really get
Mhm.
into specifics there. But in a general terms, one of the things that I saw that happened a couple years ago. First off, the 2-1 buy down, 3-2-1 buy down, all that stuff that's temporary. Um, it's really cool. I've only seen one family in my career that it actually legitimately made sense for. And here's what I mean by that. If you're banking on things getting better in the future and they don't, then you're stuck with a higher mortgage payment, period. And you're not going to unravel that. Like it is what it is unless you sell the house.
Mhm.
And I saw and have talked to plenty of people now that are like, I can't afford my mortgage payment just
Right.
because taxes or insurance went up, much less if their payment changed by an effective rate of 1% each year. Um, so I would not recommend doing that, except for like this one family that I was working with where their childcare costs were high and they knew the kid was going to school next year. So for them, they kind of offset the childcare with the mortgage payment, and it
Mm.
just for them it kind of worked out, you know. So I agree it was a good decision on their front, but you know, 3% rates are not coming back. I don't see it happening. It took a global pandemic and all kinds of other nonsense to create that problem. Um, it takes bad crap for rates to get good. I'll just say that. When
Yeah.
unemployment's getting worse, rates are getting better. So, like, you got people that are freaked out. Oh, the jobs numbers look bad. Yes, they do. That's why your mortgage rates are improving. So as long as it's not your job. I mean, I hate to be kind of callous about it. As long as it's not your job that's on that number right now, then it's a great time to make a move. That being said, I don't think that we're going to see rates go much beyond where they're at now over the next year or two. So a permanent buy down is probably the play between the two, in my personal opinion, because you're going to actually get benefit. Because all that's happening on a temporary buy down is your money's getting put in a separate account and subsidizing the payment.
Okay.
You could have done that yourself if you wanted to, you know.
Yeah. Yeah.
Um, that my recommendation is buy it down permanently if you're going to, or if you need to
Okay.
qualify or something.
Okay. Okay. Cool. Um, So, and when we do a rate buy down, that can be part of our closing costs, correct? So, like if we get a credit from a
Yep.
seller towards closing costs, that could go towards that. Okay, very cool. So that's like a good way to just overall think about that. So, and if we, I hear you saying like, why are if I can paraphrase, why are we so stuck on the rates? Because the rates are not the biggest problem, it seems like you're from what you're saying, it's like maybe we don't need to pay down a rate at all. Like, why are we so stuck in that wheelhouse? If we said, fine, keep the rate as is, what is our best way to naturally get ahead on our payment or make our payments decrease a little bit over time? So if we didn't pay down our rate at closing, how do we do that in real world life, like that we could control as we have extra cash at a time?
Yeah. So the payment itself, the only thing once the loan closes and your rate's your rate, your balance is your balance. The only
Hmm.
thing you can really do is hope that your taxes go down. Spoiler alert, they never will. Um, if they do, I'm moving to your county. And then also reshop your insurance every couple of years. So that's really the only
Okay.
other leverage you can pull. In my personal experience, I had a house in contract at one point last year that fell out due to home inspection. That home was about $25,000 cheaper than the home that I purchased. The payment on the home that I purchased is cheaper than the other one
Yeah.
because of taxes and insurance, because it's so much different in the area that I wound
Yeah.
up purchasing. And this home, I guess, in some cases, I don't want to speak on behalf of insurance agents, but in some cases, I've been told if it's a little bit newer home, it's cheaper to insure because they're not as worried about your roof blowing off tomorrow or anything like that necessarily.
Yeah. Or the mechanicals. That makes sense. Yeah.
Yeah.
Um, okay, cool. So, and then so shopping, I think insurance is a great point. Like that, I have had so many new, like first time home buyers this past year that the rates have either been okay or astronomically high compared to what I've seen in the past. So I think that's a great reminder that like we don't have to stick with our insurance company, that we have to get
Hmm.
through closing, but then we can shop it and update it in the rears, like after we own the property. And sometimes we don't have time to like think about doing the bundle packages and all of that stuff as well. So I think that's a
Hmm.
great point because that can change a lot. Um, on average, and I'm just throwing this at you. So if you're like, Brittany, why are you doing that to me? Just tell me. But I, if I paid, a little bit extra towards my principal every month, would that make up like how long do you think it would take to make up the difference if I like actually paid a rate down? So like on average, if I wanted to pay one point on my loan, give or take on like a $300,000 house, right? That might be $5,500 or so, 55, $5,700, I think was what we had talked about previously. So if we were around $5,700, then I pay a little bit extra on my principal every month. Would my overall payment go down faster paying more on my principal every month over the long term? Like, or do you think it would be better to pay the $5,700 up front? Like, if I was comparing those two options.
It wouldn't change your payment. So I just pay it up front because that would change your payment.
Okay.
That being
Okay.
said, to round it to 5,000, that's only about a 30-ish dollar payment difference. So one of the big things that I'm always talking to people about is like, if you've got a 5, 10,000, 15,000, whatever nest egg sitting there, and
Mm-hmm.
the seller's paying your closing cost or whatever, and you're like, hey, I want to use this money. The first
Mm-hmm.
stop I always make with all of it is we zoom out from the mortgage. This is really where rate doesn't matter. We zoom out from the mortgage and we say, all right, are there any other debts that you've got first? Because a mortgage is a debt on an appreciating asset. I'm not a financial planner or anything, but everyone I've ever talked to is not mad at you for having a mortgage. But
Yeah,
they are when you're paying American Express 30%, you know?
that's true. Mm-hmm.
So a lot of the times I'll reframe it there and have people use that money or sell of home money or whatever and pay off other debts. And I helped another veteran not long ago where she had about a $600 car payment, had a rate that was spectacular on her previous house, but relocated, so needed a new house. We were able to pay off that car instead. And even though her rate is exponentially higher than the 2.5 or whatever ridiculousness she did have going on, um, her overall payments really didn't change. Matter of fact, I think we
Mm,
came out about $100 ahead.
very cool.
So that's another thing to consider too. And I don't look at it ever just interest rate. I think the most important thing financially for people is cash flow.
Yeah.
Because if you've got $1,000 payment on something at 0% interest, but it's suffocating you from being able to do anything else, is that really that effective for your overall financial picture? It's,
Hmm.
in my opinion, it's a no. Ultimately, everybody listening is probably an adult. If you're a kid listening, good on you. You're kind of weird, but good job. So anyway, um, if you're listening to this and you're below 18 right now, go ahead and sign up for your real estate or mortgage licensing because
Yes, yes.
you're that kind of nerd like us. Um, but anyway, we that's the biggest thing that people mistake is
Cash
they
flow.
want to get hyper focused on rates and have their house in a silo and their cars in a silo and not connect the dots of their entire financial picture. And at the end of the day, it doesn't matter how much your interest rate is or your mortgage payment specifically. It matters how much money you got left over when you pay all your bills.
Hmm. Yeah, that's a great way to look at it. Um, on average, and I'm not asking you, I mean, I don't know how many lenders you talk to. Is this like a normal thing that lenders typically like actually look at? I know most of the time when I'm having conversations with lenders, they're talking about, your overall debt to income ratio and what your income is in general. I have not really ever heard lenders actually kind of like looking at the full picture and saying, what if you did this and what if you did that? Like, how does that change your overall, right, financial picture? So is that something normal that lenders typically do, or is that something that you just kind of have taken on and said, you know what, like I have the ability to help someone in this space?
I don't think it's typical. I think that it's 100% not going to happen if you work with somebody that's online.
Yeah,
Um, because realistically, what you're working on with there is somebody in a call center that is just churning numbers, so they don't have time to stop and think through it. To be
hmm.
most
I don't think they're
generous
taught
to
to
their
either.
position. They're
They have
not.
a
They're not
checklist and they have to check the
exactly.
box. Yeah,
Yes, and their sole job is just to make you do something and meet a quota.
yeah,
Um, in my situation, I kind of come from a place where I think it's my purpose in life to help others make as much money as possible. And I look at it where if you've got a financial planner that's handling all of your assets and stuff, or if you've got a real
hmm,
estate agent that's helping you acquire a real estate portfolio as investments, my job is to help you be sure that the defensive side of things, your cash flow protection, the debt that's necessary to pull that off is efficient for your situation. Um, it's more of an advisory type thing that I try to do with people for those that get it. Um, every loan advisor is going to be talking about debt to income because that's really what controls how much house you're going to buy in almost every case.
right.
But a lot of the time they'll just do it based on debt to income, and if you qualify, and that's that. Um,
Yeah,
I just I try to give the advice that I would give if my best friend's calling and saying, "Hey Matt, what would you do here?"
yeah,
So and some people take the advice, some people don't. Some people take the extra cash flow and instead of maxing out their 401k, they buy a new Harley. And if that makes them happy, okay, probably not what I would do with it, but do you.
yeah. There's a time and place, right? No, I absolutely love that. And I think, the generational wealth conversation is where like we align greatly with that. I love that you will look at the whole picture and just say, if you did this, what does this do for your future, right? Not only the impact for today, but what does it look like in the future for you? And I think that's really awesome because with VA, a lot of times our future is so uncertain. I mean, and you
Mhm.
and I have conversations about this all the time, one to one. You are the person that I will call and say, "Am I crazy about this, or should I be looking at this for our own world?" And I think that that's really cool to have that um, in a lender that also can see the full picture. So you're not coming at it with like well, Brittney, you really suck at life because you don't have cash coming in. You're like, you can look at it from the asset point of view. So it's better than a financial planner from that stance, in my opinion. Um, and I think you're really going to be creative about that, which is super, super cool too. So one of the things that we come across a lot with VA is that people expect that they're going to be somewhere for a long time and then they're not. Like life
Mhm.
happens or things change. And that's where like some of this stuff really matters the most. If I had somebody that is just in a situation where life has changed and they are no longer going to be in this property and they're kind of upside down in it, from the lending point of view, what should we do? What should we do? Should we try to sell it the best that we can and take a loss? Are there programs specifically for VA to help if they're upside down that you're aware of? Are you on the boat of rent it until it can clear itself? Like, what do you think we should be having the conversation with our VA folks that are not in a great situation and no longer at the house?
Sure. Um, so first off, a lot of people don't realize that you can actually have multiple VA loans. There's no limit on the
Okay.
number of VA loans you can have. There's just a limit on your entitlement. I won't go into that on this because it's everybody will
Yeah, it's a
decide to
whole nother
turn this off then.
conversation.
Yeah. Nobody wants to hear that math. But just know that it is possible to own multiple houses on a VA. So you can PCS to another place or, say you separate and you move back home, whatever. You can have another VA loan in most cases, unless you bought a really expensive house to start with. Um, that being said, to your point about being upside down and stuff, I'm not personally familiar with any programs that are out there that'll help like buy out negative equity or anything like that for veterans necessarily. There may be, I don't know. I just don't want to speak out of turn on something I don't know.
Yeah.
My recommendation in all cases where that's the case, that's you're upside down or, barely breaking even or something is if you can rent it out until you don't. I heard Brian Buffini, a real estate coach, one time talk about how in real estate, it's pretty much the only asset that you can guarantee yourself you don't lose, as long as
Hmm.
you're willing to withstand the pain and able to withstand the pain in the meantime.
Hmm.
And what he meant by that was like, you in general, real estate assets are going to go up in value over a long enough time horizon. As a matter of fact, at no time in history that anybody's owned a home for 10 years or more have they lost money on that house.
Yep.
So if you can hold on for a decade and deal with tenants in another state or down the street or whatever the case may be, rent it out. If you can deal with it, maybe the rent doesn't cover everything, but maybe you also don't lose your shirt whenever you sell the thing. You got to buy out 20, 30, $40,000 of equity. The thing is, I talk to people all the time that are stuck on like, well, what if I lose out? Or my buddy bought a house in 2022 and then they're upside down and can't go anywhere. Well, first off, it's never been a good idea, except for like 2020, to buy a house and stay there for 2 years and sell the thing. It's just
Yeah.
there's transaction fees associated with moving, closing costs, all the things are going to happen that's going to eat into whatever, profit you thought you were going to get. Um, and that's just not the case. If you look over real history, there's
Hmm.
enough appreciation there that 5 to 10 years is really where it makes sense. And as it turns out, 7 years is the average anybody keeps a house. So anyway, that would be my recommendation if you can stand it. If you can't, then it'd be one of the weird situations where I would recommend you potentially rent at the other place if it is cheaper to do so month to month to allow you to continue paying the difference in payments on the previous home or something.
Hmm. Hmm. Yeah. Yeah, I agree with you on that. I think, this year, I think that is my challenge, right? Like this coming year, anybody that bought in 22 to 24, they are starting to see transitions and get orders or getting out of the military. And they bought high and they have high rates. And it has been very, very challenging,
Mhm.
um, to get them out from underneath of that. So I think that's just something where, once again, I hope that we can like have the same conversation across the board with other agents and lenders so that they understand that there's ways to protect them for the long haul, not just look at the right now picture. So thank you for, agreeing on that and kind of expanding on it. If anybody took one piece of advice or comment or suggestion that you had from today away, what's the one thing you would want them to hear about loans right now in the VA world, like that they really should hold on to?
Um, I'll take a left turn just a little bit here. One of the things that I didn't talk about that I think they should also consider is along the same lines as like putting money towards paying a car off or something instead of putting it extra down on the house when you move.
Mhm.
Um, Doing a cash out refinance and sometimes even increasing your rates, not the end of the world. If the equity's there and you can consolidate debt and wind up with a better cash flow situation, I recommend that 10 times out of 10. Because I've helped many families that have been in a boat where they needed, they didn't realize that having their 3% rate from several years ago that sounds really cool was actually crushing them because in the meantime, life's happened. I mean, we all got strapped over the
Hmm.
last couple of years as inflation's killed
Hmm.
us and stuff like that. Um, you can consolidate that a lot of the times and do it before it's too late, where you start missing payments and really screw yourself up, and help fix that cash flow situation. And I'm saying all this not as some dude on some golden high horse over here. I personally have been in six figures of credit card debt at a point in my life.
Yeah.
These are things that I did myself to help right that ship, because once you get so far behind, that debt treadmill gets turned up too high.
Right.
And you know, I know the Dave Ramsey people would say like, "Oh, don't do that because it's about the habit." Sure, but if you're drowning to begin with, you need some cash flow to start paying off the debt with.
Right. You got to get to neutral. Yeah.
Yeah,
Yeah.
yeah, absolutely. Um, so that would be, I would just say like cash flow. Cash is not king, cash flow is king.
Hmm.
And it's all coming from a guy that's been there before and probably added a zero to the stupidity.
Yeah, yeah. No, I agree with you. We've done that on some of our properties where like it either afforded us to be able to get another property or just to survive. We have figured out, like you said, every time you transition with the military, on average, we pay at least $5,000 out of pocket just on our like transition, between hotels or travel or whatever that the military doesn't pay us back for. So that adds up very quickly when you're moving every couple of
Hmm.
years. So you think that you have a good nest egg, and then in a couple of years, it is just gone. So I love that because there's so many people that honestly cannot get past the fact that I have a 2.25 interest rate and I cannot sell this house. There's no way in hell I'm ever selling this house. That's a great hack to say, you know what, maybe you're going to lose that 2.25, but did you know, because you have so much equity in it, it's still going to cash flow even if you refinance it, right? You could still rent it, you can still cover it, and it's still an appreciating asset. So it's a great way to look at that like sometimes there are different ways to look at that. And also, just a reminder that if you have multiple properties and you are renting multiple properties, look at it as a portfolio. Once again, the full cash flow
Hmm.
picture, not just property to property, because sometimes that might look like this one has equity in it, but if I refinance it, then all of a sudden I'm upside down. My rental rate is a little bit lower than what my new mortgage is going to be. However, I'm getting rid of this huge debt and I have this other property that cash flows more and it equals out. So I'm still winning overall with the cash flow game. So that's a great reminder. And I think that's cool that like you're able to show us that, like, and think outside the box and help us run the numbers. So if somebody was like interested in trying to do anything that we've talked about, refinance, do pull out some cash, or just learn about how to make a portfolio with VA loans, what should they do? How should they reach out to you and start that conversation?
Yeah, we can post if you wanted to put my number in the description, and then my
Yeah.
website link there. That way, just click on that, and then we'll schedule up a call and have a conversation. My recommendation always is to start with doing the questionnaire or the application. Not going to do a soft pull up front. And if you talk to a lender that only requires a hard pull up front, talk to a different one. That's my recommendation.
Yeah.
But the soft pull is enough for us to run some educated numbers. In reality, until you've done an application with somebody, everything they're telling you is crap.
Hmm.
Um, it's all hypothetical, and I prefer not to speak in hypotheticals when possible. So take the 15 minutes and do that for sure. And then in my situation, we hop on Zoom and we'll walk through numbers in real time and see what works for your situation.
Very cool. And then your recommendation, how far out should buyers be talking to a lender right now? What is their average that you're seeing? Like if they want to buy, should it be 3 months, 6 months? How far out should they connect?
Depending on where your credit situation's at. Like if you know that your credit kind of sucks, no judgment. Lots of people have credit issues and things like that. The
Hmm.
fact is, nobody taught you in school how to play the game credit wise. So if you know you got credit issues, probably 12 months, because
Okay.
most situations can be fixed in 12 months. But if you also know that, hey, I got decent credit, I've got good income, all that stuff, I'd say 3 to 6 months out is perfect.
Perfect. Awesome. Thank you so much for all this information. You are always a wealth of information. And once again, I always love that you are super transparent and willing to see the whole picture, not just focus on the job at hand. So thank you for that.
Thanks for having me. It's been a pleasure.
Hey, I just wanted to say thank you for being here and listening in on this episode of Closing Chapters with me. I truly enjoy putting this content together, and I hope that you enjoy it too. If so, could you like, subscribe, and share this episode with somebody you know that will enjoy it just as much as you did? Thank you so much.